upside-down mirror.
And you would really think that a 12 million barrel hole in global oil supply, combined with a fiercely hawkish Fed, would just be a recipe for a total market bloodbath today.
Oh, absolutely. I mean, by all traditional laws of financial gravity, a day like today really should have cracked equities wide open.
Right. But today, Thursday, June 4th, 2026, those textbook rules just completely broke down.
Yeah, they really did.
So welcome to this deep dive where we take the absolute fire hose of market data and try to distill it into the mechanics of what actually matters for your portfolio.
Exactly. And, today we're going to unpack the overnight oil and trade setup, analyze those massive geopolitical shifts that basically unwound the energy markets during U.S. hours, and break down the latest AI monetization strategies from mega cap tech.
It's a packed agenda. But before we jump in, just a quick reminder for you all. Everything we discuss here is for market context and discussion. It's not personal investment advice or, an investment recommendation.
Yeah, please don't trade just based on what we're chatting about here.
So, session one.
Yeah.
What set the stage before the U.S. session?
Well, let's pull the lens back to the overnight setup because you really can't understand the resilience of today's U.S. session without looking at the massive physical supply deficit we were staring down.
Right, the Novak comments.
Yeah, exactly. So at 3:21 a.m. Eastern Time today, Russian Deputy Prime Minister Novak made this staggering admission. He flagged that roughly 12 million barrels per day of oil remain undelivered to the global market due to the Middle East conflict.
Wait, 12 million barrels?
12 million.
I mean, to put that into perspective, the whole global economy consumes roughly, 100 million barrels a day?
Right around there, yeah. So we're talking about 12% of the world's daily energy lifeblood just vanishing from the delivery chain.
That's insane. And oil isn't, it's not a digital asset. You need super tankers, complex maritime insurance, specific routing.
Right.
When 12% of that capacity is blocked, the physical supply chain is just starved.
Exactly, which creates a massive bidding war for any available spot cargoes. But the immediate spin from Novak was, a call for calm.
Of course it was.
He assured the market that OPEC Plus is positioned to offset these changes. He said Russia expects to hit its output quota without a diesel export ban for now.
But, here's where I struggle with this narrative. Are we putting entirely too much faith in these verbal assurances from OPEC Plus Gulf?
I think we might be.
Like, the oil is literally not moving through the Strait of Hormuz. We're trusting a restaurant kitchen that's missing a massive chunk of its raw ingredients, but the head chef is out there swearing dinner service will be fine.
And that tension is exactly why oil has been so volatile, right? The market is treating OPEC Plus the way it treats the Fed. They're pricing in the mere capacity to offset the shock based on words.
But spare capacity on paper is very different from physical barrels at a refinery.
Yeah, if the logistics of rerouting that oil become too complex, those verbal assurances evaporate instantly.
And as if that 12 million barrel deficit wasn't enough,
yeah,
we also had to digest a major tail risk out of Asia overnight.
Oh, right, the North Korea news.
Yeah, which actually broke Wednesday at 5:08 p.m. Eastern Time. Kim Jong-un was seen reviewing a uranium enriching plant. It basically signaled a massive boost in their nuclear capabilities.
Which is huge because the market has been so hyper-focused on the Middle East, it's easy to forget the Korean Peninsula is still one of the most potent geopolitical risks out there.
Absolutely. Any escalation there directly threatens Asian semiconductor supply routes.
And let's be real, those routes are the absolute lifeblood of this entire multi-trillion-dollar AI infrastructure rally. If they freeze, the hardware build-outs stop.
Which totally explains the visceral reaction we saw in safe haven assets. Gold caught a massive bid, whipping up to an intraday high of $4,543.20 before it settled lower.
A brief but very intense reminder that global stability is walking on a razor's edge right now.
Yeah, and compounding all that anxiety, we had fresh trade friction hitting the tape early this morning.
At 3:07 a.m. Eastern Time, U.S. Trade Representative Greer warned of a highly complex Section 301 probe regarding overcapacity coming in the next few weeks.
And let's unpack that, because a Section 301 probe isn't just a firmly worded letter. It's a statutory hammer. It gives the U.S. broad authority to retaliate against foreign trade practices.
basically preparing to wall off market access.
Right. And then on the other side of the Atlantic, EU Trade Commissioner Šefčovič stressed the absolute necessity of finalizing the Turnberry parameters.
Yeah, drawing a hard line on capping inclusive tariffs at 15%. And again, the Turnberry parameters aren't just a simple tax. If a trading partner breaches that 15% cap with subsidized goods, it triggers an automatic supply chain freeze across European ports.
It's a binary cliff edge for global trade. So overnight markets were juggling massive supply deficits, nuclear posturing, and trade tension. It was an absolute pressure cooker.
It really was.
But let's take a quick break here, because when we come back, we need to talk about how all that pressure completely deflated during the U.S. day.
Sounds good.
All right, we're back. So, session 2. What moved markets during U.S. trading hours?
Well, the dominant driver of the entire day became a massive, violent plunge in oil prices.
Yeah, we started getting these rapid-fire headlines that the U.S. and Iran are nearing a Hormuz ceasefire framework.
Right, alongside Israel and Lebanon agreeing to implement ceasefire pilot zones.
President Trump even came out and noted negotiations are going well, and a deal to open the strait could happen soon.
And Treasury Secretary Bessent remarked the conflict has basically been halted.
And the market reaction was just wild. WTI crude violently plunged from $95.91 all the way down to an intraday low of $91.91. It eventually recovered a bit to close at $92.90.
We talk a lot about geopolitical brinkmanship as negotiation leverage. You push things to the absolute limit, oil spikes, and then you use that economic pain to force a deal.
But okay, let me push back on this through a game theoretic lens, because I think equities might be getting way ahead of themselves. Are markets tracing ahead of physical reality here?
I mean, it's highly likely.
Right, because Iranian hardliners, like General Rezai, are still setting territorial conditions. And the IAEA just reported they have zero access to verified nuclear materials. A ceasefire isn't just some natural disaster that gets cleaned up.
Exactly. The debris is still everywhere. In game theory, this kind of ceasefire is just a temporary change in the payoff matrix. The underlying friction is not solved at all.
The market aggressively sold off because it desperately wants to believe the oil will flow tomorrow.
But if there's even a minor infraction, oil is going to violently snap back. It's a highly conditional, fragile equilibrium.
And it's fascinating because that conditional handshake was basically the only thing keeping U.S. equities afloat today.
Oh, yeah. The Fed was aggressively building a hawkish wall on the macro side.
At 8:30 a.m. Eastern Time, U.S. initial jobless claims ticked up slightly to 225,000, which beat the 215,000 forecast.
And productivity expanded at a very tepid more 0.3%. That marginal labor softening gave equities a slight early lift.
But then the inflation reality checks hit the tape. At 9:39 a.m. Eastern Time, the IMF warned of clear pass-through from U.S. tariffs and oil.
This was huge. They officially pushed their projection for a return to the Fed's 2% target all the way back to the end of 2027.
Wait, end of 2027?
Yeah, 3 years away.
Wow. And combine that with the chorus of Fed speakers we heard today, right? Logan, Daly, Schmid. They all aggressively hammered home that policy must remain restrictive to fight this energy and tariff inflation.
Because they have to protect central bank credibility as an inflation anchor.
Exactly. And then at 9:50 a.m. Eastern Time, the U.S. Treasury announced massive upcoming supply, $39 billion in 10-year notes and $22 billion in 30-year bonds.
A literal flood of supply. So you have the IMF delaying the inflation target, a hawkish Fed, and massive Treasury supply.
And despite all that, the 10-year yield just sat there, flat near 4.477%. The S&P 500 absorbed that early weakness and rallied. S&P futures went from a low of 7,524.50 to close at 7,589.25.
And the Nasdaq futures bounded back to 30,410.25.
So basically, collapsing oil prices effectively canceled out the hawkish Fed fears during the U.S. session.
That's exactly what happened. Lower oil means lower headline inflation tomorrow, giving the market an excuse to ignore the Fed.
Incredible resilience. All right, let's take one more quick break before we pivot into the corporate side of things.
Great.
And we're back. Session 3, corporate events recap and what to watch next.
So while the macro picture was wrestling with oil, the the corporate world was accelerating this infrastructure arms race.
Yeah, we had a flurry of tech announcements hit around 4:15 p.m. Eastern Time on Wednesday, and they really rippled through Thursday's session.
Meta is reportedly aiming to charge up to $200 monthly for its planned Hatch AI assistant.
$200 a month, that is a serious price tag.
It really is. And Google announced a major cloud partnership with IBM and new data center investments in Texas.
It's just wild. I mean, we've talked about AI CapEx as a cycle-agnostic arms race, but are these aggressive monetization plans like Meta's $200 fee, are they signs of incredible fundamental demand? Or is this just tech, mega CapEx, as a market fragility mask to justify these staggering expenditures?
That's the defining debate right now. Are they throwing massive numbers against the wall because they've already irrevocably committed to the infrastructure?
Yeah, because the scale of the capital being drained is unprecedented.
Right, the mega capital drain. This narrative carried over from Wednesday evening. SpaceX filed for a massive $75 billion IPO.
$75 billion.
Yeah, with Goldman projecting their AI revenue to surge 100x by 2030, and Alphabet recently upsized its equity raise to $84.75 billion.
So you have equity issuance's mechanical dilution here. That capital doesn't come out of thin air. It mechanically drains liquidity from the broader market.
Exactly, which is why mega cap tech has felt so heavy.
Which actually perfectly sets up our closing bell joke for the day.
Oh boy, let's hear it.
Well, folks, today we watched WTI crude drop faster than anyone willing to pay Meta's planned $200 monthly fee for a new AI assistant. Between the Middle East ceasefire hopes, cooling off oil prices, and SpaceX trying to casually raise $75 billion in a record IPO, it's been a wild ride. The Fed might still be hawkishly staring down inflation, but at least your portfolio managed to stage a solid afternoon comeback. So go ahead and celebrate today's victory, because the only thing more volatile than this market is wondering what will happen with the Hormuz Strait tomorrow.
That is painfully accurate.
Right. So looking ahead, what should listeners be watching next?
Tomorrow, Friday, June 5th, 2026, at 8:30 a.m. Eastern Time, we get the pivotal May U.S. employment report. That includes non-farm payrolls, the unemployment rate, and average hourly earnings.
A massive data drop. Now it is time for our bonus session, paper trading.
Let's do it.
So quick intro for the new folks. We run a live 2-minute paper trading experiment. The objective is to beat the S&P 500 using a $10,000 starting value across a universe of 13 macro ETFs.
And as of today, the portfolio is up 12.27%, which is strongly outperforming the S&P 500's 6.43% return.
Not too shabby.
Not at all. So what's your play?
All right, here's my decision. I am selling $1,100, which is about 9.8% of the portfolio of XLE, the energy ETF, and I'm buying $1,100 of XLU, the utilities ETF.
Okay, walk me through the justification.
Well, geopolitical brinkmanship as negotiation leverage is rapidly deflating the risk premium in energy. With markets pricing ahead of physical reality, I want to lock in profits from our heavy XLE overweight before this ceasefire ink dries.
Makes sense.
And I'm buying XLU because utilities are the backdoor play on the massive AI CapEx cycle. Energy access as an AI bottleneck is very real. Plus, it provides defense against discount rates as financial gravity if tomorrow's jobs report keeps yield high.
You know, I agree completely. I am making the exact same trade, selling XLE, buying XLU.
Nice.
Because honestly, Alphabet and SpaceX's capital raises act as mechanical dilution for pure tech. So physical power constraints utilities are just the smarter cycle-agnostic allocation right now.
Love it. So, final decisions for the listener. Execute a sell on XLE and a buy on XLU at tomorrow's close.
And as always, a quick disclaimer. This is not financial advice. Past performance does not guarantee future returns, and the live experiment may fail at any time. Don't copy this with real money.
Exactly. Well, we covered a ton of ground today, but I want to leave you with this final thought. If the entire market is aggressively pricing in global peace before treaties are even signed, what happens to your portfolio if a single rogue actor decides to break the rules of the game tomorrow morning?
It's a scary thought.
Let us know your thoughts and predictions in the comments below.